Markets rarely move the way people expect. They rise when the economy feels strong, and sometimes they rise when nothing fundamental has changed. Then they fall, often suddenly, even when nothing obvious breaks. News headlines usually blame events, a crisis, a war, a bank failure, a policy change. But underneath all of that, something more consistent is always at work: liquidity. Not just money, but the ease with which money moves through the system. And when liquidity expands or contracts, markets don't just react, they transform. This is why markets boom and crash. What liquidity actually means. Liquidity is often misunderstood. People think it simply means cash in the system. But in finance, liquidity is broader than that. It refers to how easily money can be borrowed, spent, invested, leveraged. When liquidity is high, capital flows freely. Credit is easy to access. Banks lend more willingly. Investors take more risk. Asset prices rise quickly. When liquidity is low, the opposite happens. Even strong economies can feel weak in low liquidity environments, because liquidity determines movement, not just value. Where liquidity comes from. Liquidity does not come from one place. It comes from a system. Three major sources dominate. First, central banks. They influence liquidity by setting interest rates and controlling reserves. Second, commercial banks. They create liquidity through lending. Every loan increases money circulating in the economy. Third, financial markets themselves. Through leverage, margin, and credit instruments, markets amplify liquidity conditions. When all three expand at the same time, liquidity surges. When all three contract, liquidity disappears quickly. Why markets love liquidity. Liquidity is the fuel of asset prices. When borrowing is cheap and abundant, investors take more risk. Companies expand faster. Consumers spend more freely. Speculators enter markets aggressively. This pushes asset prices upward, not necessarily because underlying value changed, but because more money is chasing the same assets. This is why markets often rise during periods of low interest rates, and why liquidity is often more important than economic growth itself in the short term. Most liquidity cycles are credit cycles in disguise. When banks expand lending, new money enters the economy. This increases deposits, spending, and investment. Asset prices rise. Rising asset prices improve collateral. Better collateral encourages even more lending. This feedback loop accelerates liquidity. It is self-reinforcing, until it is not. How booms form. A boom begins quietly. Interest rates are lowered. Credit becomes easier. Borrowing increases gradually. At first, the impact is subtle. Then it accelerates. Asset prices begin to rise faster than incomes. Rising prices attract more participants. Media attention increases. Risk feels lower because prices keep rising. And slowly, perception shifts. People stop asking, "Is this cheap?" and start asking, "How high can it go?" This is the psychological phase of liquidity expansion. Confidence becomes part of the system. At the peak of liquidity cycles, the system changes character. Credit is abundant. Risk spreads widely. Even weak assets can find buyers. But something important happens. Future expectations become stretched. Prices assume continued expansion of liquidity. Debt levels rise faster than income, and the system becomes fragile, even if it looks strong, because strength is now dependent on continuous liquidity flow. Liquidity cycles do not end randomly. They turn when conditions shift. Often the trigger is inflation. Central banks raise interest rates to slow the economy. Borrowing becomes more expensive. Credit expansion slows. At first, markets may ignore this, but liquidity works with delay. The system does not respond instantly. It responds gradually, and then suddenly. When liquidity contracts, something critical happens. There are fewer buyers for the same amount of assets. Investors who relied on borrowing must sell. Leverage is reduced. Debt is repaid. Positions are closed. This creates forced selling, and forced selling creates falling prices. Falling prices reduce collateral values.
Lower collateral forces even more selling. This feedback loop reverses the boom. What once expanded liquidity now destroys it. Why crashes feel sudden? To observers, crashes often feel sudden, but liquidity rarely disappears instantly. It tightens gradually. The early phase is invisible. Credit becomes slightly harder to obtain. Lenders become slightly more cautious. Risk appetite quietly declines. Then a tipping point is reached. At that moment, liquidity stops flowing smoothly, and markets, which depend on continuous flow, adjust violently. This is why crashes feel abrupt, even when they are built slowly.
Central banks play a crucial role in modern liquidity cycles. When markets contract too sharply, they can intervene, lower interest rates, inject liquidity, purchase assets, stabilize credit markets. These actions create a liquidity floor. They do not eliminate cycles, but they can soften extremes. However, this introduces a long-term effect. Markets become increasingly sensitive to central bank behavior, because liquidity itself is partially policy-driven. Why liquidity cycles repeat? Liquidity cycles repeat because they are rooted in human and institutional behavior. During good times, optimism rises, risk is underestimated, credit expands. During bad times, fear rises, risk is overestimated, credit contracts. These shifts are amplified by the financial system itself, because banks, investors, and institutions all respond to the same signals. This creates synchronization, and synchronization creates cycles. Liquidity cycles are not local, they are global. When liquidity is abundant in major economies, capital flows outward. Emerging markets receive investment. Commodity prices rise. Global risk-taking increases. When liquidity tightens, capital retreats. Currencies weaken. Debt becomes harder to service. Entire regions can experience economic stress without any internal shock, because they are connected to global liquidity conditions. Markets are often described as rational systems responding to information, but at a deeper level, they are liquidity systems responding to flow. Prices do not move only because value changes. They move because money becomes easier or harder to move through the system. Liquidity expands confidence. Liquidity contraction creates fear. And between those two states, entire economic cycles are formed. Understanding liquidity does not remove uncertainty from markets, but it reveals the structure underneath the uncertainty. Because in the end, markets do not just reflect the economy, they reflect the movement of liquidity through it. If you enjoyed this episode, subscribe for future deep dives into investing, macroeconomics, financial history, and global markets. In next episode, we will explain inflation, deflation, and stagflation. Subscribe and stay with us. See you in the next videos.